What happens to a market when the government quietly decides that prices are no longer allowed to fall? On Wednesday, U.S. Vice President J.D. Vance confirmed that the United States will establish a price floor system for critical minerals, a policy framework designed to guarantee minimum prices for materials deemed strategically essential. Silver is included on that list. This is not a headline about speculation or stimulus. It is about industrial survival. A price floor exists for one reason: to keep domestic production alive when paper markets push prices below real-world costs. If futures prices fail to cover mining, refining, and security of supply requirements, the floor does not follow the paper market. The paper market is forced to adjust upward to the floor. That is how price floors work. If the minimum price for silver is set above today's paper price, the adjustment is mechanical, not emotional. This is not a rally. It is a repricing event driven by policy. The closest historical parallel is the Strategic Petroleum Reserve, where the U.S. government acts as buyer of last resort to stabilize critical supply chains. The difference is scale and precedent. Oil has had this backstop for decades. Silver has never had one in modern precious metals markets. That alone marks a structural shift. Markets built on leverage and derivatives now face a hard policy boundary tied to physical production costs. If you want unfiltered, real-time analysis of how decisions like this reshape the global financial system, welcome to GB Economy, where we deliver in-depth analysis of economics, finance, and the underlying rules that govern markets. If you find value in this content, don't forget to hit the like button to support the channel and subscribe to GB Economy to receive more high-quality insights. If the policy shift sets the long-term framework, the price action tells us what is happening right now. Over the past 2 consecutive trading days, silver has traced an almost identical intraday pattern that is too consistent to ignore. During Asian and European hours, prices pushed aggressively higher, driven by physical demand and tighter regional supply. Both sessions carried silver back toward the $90 level, only for the move to fail once New York trading opened. Each time, heavy selling pressure emerged within hours of the U.S. session, forcing sharp reversals of 8–9%, with prices falling back into the low to mid dollar ADS. Crucially, despite multiple tests, silver has not recorded a single daily close above $90. That level is acting as firm overhead resistance, not by coincidence, but by structure. On the hourly chart, the 150 period EMA sits near $96.97, roughly $10.11 above current prices around $86, reinforcing the idea that paper markets are defending higher technical levels aggressively. The repetition matters more than the magnitude. This is not random volatility. It is the same sequence repeating across sessions: strength overnight, distribution during New York hours, and rejection at the same price zone. The implication is clear. Physical buyers are accumulating when global markets are open, while U.S.-based derivative selling dominates during American trading hours. In simple terms, real metal is being bought and paper exposure is being sold. Until this pattern breaks, either with a sustained close above $90 or a failure of New York session selling it, remains the dominant short-term signal, even as longer-term structural forces continue to build underneath the market. The repeated price rejection would be easier to dismiss if physical demand were fading. Instead, the opposite is happening, and the data is unequivocal. In the first 4 trading days of February, the COMEX recorded 2,955 silver delivery notices, representing 14.8 million ounces of metal standing for immediate physical delivery. To put that number in context, open interest in the February silver contract stood at just 1,231 contracts at the close of January. Within 2 days, delivery requests had already reached more than 2.4 times the entire open interest, and at points nearly 3 times that level. This is not a rounding error, it is a structural anomaly. February is a non-primary delivery month, typically characterized by light activity and minimal physical movement. Primary months, March, May, July, are where large deliveries usually occur. Yet February has already posted record-setting physical demand, and the month is barely underway. Even more telling is what happened next. Despite the surge in delivery notices, open interest in February remained relatively low. That means new buyers are not rolling positions forward or maintaining exposure. They are standing for delivery, taking the metal, and exiting the paper market entirely. This behavior has now occurred for the 2nd consecutive month, eliminating any argument that it is a one-off event or calendar quirk. The message from the physical market is clear. Real buyers are indifferent to short-term paper volatility and are prioritizing possession over price. While futures prices swing violently during U.S. trading hours, physical silver is quietly being removed from exchange inventories at an abnormal pace. When delivery demand exceeds open interest by multiples, especially in non-primary months, it signals stress beneath the surface. Paper markets may still dictate intraday price, but the physical market is sending a far more consequential signal. Supply is being absorbed, not recycled, and that imbalance is accelerating rather than easing. This surge in physical delivery would already be significant on its own, but the underlying market stress becomes even clearer when viewed through derivatives data. The silver swap rate relative to U.S. interest rates, a key indicator of funding pressure and availability, has moved into territory not seen in modern history. Current readings show imbalances exceeding those recorded during the 2008 global financial crisis and even surpassing the extremes of the 2011 silver peak, when prices briefly approached $50 per ounce. In both of those periods, severe dislocations in the paper market preceded violent repricing events. What matters now is not the absolute level of price, but the structure behind it. A deeply negative swap spreads signals that participants are paying a premium to access silver exposure, reflecting scarcity and stress beneath the surface. At the same time, the sharp sell-offs observed during New York trading hours are being driven primarily by over-leveraged paper positions, futures, swaps, and algorithmic strategies reacting to margin, volatility, and risk-off flows. This selling does not represent an increase in physical supply, nor does it reflect weakening end-user demand. It is mechanical, not fundamental. When derivative pressure intensifies while physical demand accelerates, the result is a widening disconnect between price discovery and real-world availability. History shows that such divergences do not resolve quietly. They persist until leverage is flushed out or price is forced to adjust. In this case, the data increasingly suggests that paper-driven volatility is masking a structural shortage rather than signaling genuine weakness in the silver market. These structural stresses are unfolding against a deteriorating global risk backdrop, amplifying volatility across every major asset class. In U.S. equities, selling pressure intensified sharply, with the S&P 500 shedding roughly $580 billion in market capitalization in a single session, while the Nasdaq erased nearly $1 trillion, reflecting broad-based liquidation rather than sector-specific weakness. This was not an isolated equity move. It coincided with a clear shift toward risk-off positioning across global markets. At the same time, reports that U.S.-Iran nuclear negotiations were canceled added a geopolitical shock, immediately pushing oil prices towards $65 per barrel as supply risk was repriced into energy markets. In Asia, volatility was just as pronounced. China's four largest gold-backed ETFs recorded $980 million in net outflows in one day, followed by another $317 million the prior session, bringing the two-day total to a record $1.3 billion, the largest withdrawal ever observed in that market. This does not signal collapsing demand, but rather rapid sentiment swings and forced rebalancing under tightening financial conditions. Crypto markets echoed the same stress. Bitcoin fell below $73,000, while Ethereum dropped under $2,100, levels not seen since mid-2025, wiping out billions in leveraged positions in a matter of hours. The common thread across all of these moves is not fundamentals deteriorating simultaneously, but capital retreating in response to rising uncertainty, tighter liquidity, and geopolitical risk. When equities, crypto, and commodities all sell off together, it points to a systemic risk-off phase rather than asset-specific failure. In this environment, paper-driven volatility tends to intensify as leveraged positions are reduced indiscriminately. Yet history shows that periods like this often mask deeper structural shifts. While financial assets are being liquidated to raise cash, underlying physical demand for strategic commodities remains intact. The contrast between financial market stress and real-world accumulation is widening, and that divergence is becoming one of the most important signals to watch as global risk continues to rise. While financial markets swing violently under risk-off pressure, central banks are operating on an entirely different timeline, and their actions carry far greater weight. Over the past several years, global central banks have accumulated more than 5,000 metric tons of gold, marking the largest sustained buying cycle in recorded history. This is not speculative demand. It is strategic accumulation driven by balance sheet security, currency credibility, and geopolitical insulation. Unlike private investors, central banks are price-insensitive buyers. They are not attempting to time short-term moves or capture volatility. They buy to remove metal from circulation and hold it as a long-term reserve asset. The geographic pattern of this accumulation is equally revealing. Countries such as China, Russia, India, and Turkey have led purchases, steadily increasing official gold reserves year after year, even during periods of price weakness or market drawdowns. These purchases continued through 2024 and into early 2025, underscoring that the motivation is structural rather than cyclical. At the same time, a divergence is emerging between how different regions engage with the metals market. Outside the United States, physical metal is increasingly treated as a strategic asset tied to national resilience. Within the U.S. financial system, price discovery remains heavily concentrated in paper-based markets, dominated by futures, swaps, and leveraged instruments. This split matters. When the largest and most patient buyers in the world are steadily removing physical supply while prices are set by short-term derivative flows, the market becomes structurally unstable. History shows that such imbalances persist quietly until they do not. Central banks rarely announce turning points, but their balance sheets reveal intent. And right now, those balance sheets are signaling a sustained shift away from reliance on paper claims and toward tangible monetary assets, even as market prices struggle to reflect that reality. All of these forces converge into the central conflict, now defining the silver market. In the short term, price remains capped by aggressive paper selling during U.S. trading hours. For 2 consecutive sessions, silver was pushed toward $90, only to be rejected each time with rapid 8-9% declines, and it has yet to record a daily close above that level. This behavior reflects the dominance of leveraged futures and algorithmic strategies in the New York session, where price is set by positioning and liquidity rather than physical availability. Yet beneath this surface volatility, the long-term structural picture is moving in the opposite direction. Government policy is shifting toward price floor mechanisms for critical minerals. Physical deliveries on exchanges have reached record levels in non-primary months, and derivatives data is signaling imbalances larger than those seen in 2008 or 2011. These are not short-term signals. They point to constraints building within the system itself. When a market is simultaneously capped by paper flows and supported by policy, physical demand, and strategic accumulation, tension accumulates rather than resolves. History suggests that such divergences do not persist indefinitely. Either paper pressure eventually exhausts itself, or structural forces force a repricing that overrides short-term suppression. The critical point is timing. Traders focused on intraday moves will continue to see volatility and false breaks. Those watching structure see something else entirely. 2 opposing forces pulling the same market in opposite directions, with the gap between them widening rather than narrowing. At this point, the central conclusion becomes unavoidable. The paper-silver market and the physical reality beneath it have fully decoupled. Futures prices are being driven by leverage, positioning, and short-term liquidity flows, while physical metal is being absorbed through record deliveries and strategic accumulation. The result is a price that no longer reflects silver's strategic role in energy, defense, and industrial supply chains. That is why the debate has shifted. The question is no longer whether silver matters. Policy has already answered that by classifying it as a critical mineral. The real question is when the price floor mechanism is formally implemented and how quickly prices are forced to adjust once that floor comes into effect. When governments step in as buyers of last resort, markets do not grind higher, gradually they reprice to a new reference level. This creates a clear decision point for investors. Those focused on the short term will continue to trade volatility in the paper market, reacting to New York session selling, technical resistance, and leverage-driven swings. Those with a longer horizon must evaluate structure instead, government policy, physical delivery trends, and historic market imbalances. Both approaches carry risk, but confusing one time frame for the other is where most mistakes are made. Thank you for watching. If you have a different perspective or see this market developing another way, share your view in the comments below.